Well, ADP came out with its jobs report in the last hour, reporting that companies hired 91,000 workers. The expectation was for 100,000. For more on what this means for the markets and the economy, we are joined by a Bloomberg Best on the economy. He's the chairman and chief investment officer of Hugh Johnson Advisors. Hugh Johnson. Also with me, of course, is Dominic as well as John. So, Hugh, what do the numbers tell you?
Well, first of all, it's a very tough number. These numbers from ADP are tough to forecast, just as non-farm payrolls are tough to forecast. They're pretty much in line with expectations, and what they tell me is that, statistically speaking, is that the non-farm payroll employment for the month of August probably increased about 80,000, with private sector jobs increasing about 95,000 jobs during the month of August, and that's what these numbers tell us. But you hold on to your seat, because you never know. These are very tough numbers to forecast. That's what Friday's numbers look like. Not great, but certainly not, they didn't fall off the cliff, or they're not dismal.
Well, Hugh, it's Dominic here. One of the things that a lot of traders that we've been talking to have been saying is that, you know, they looked at this correlation, this relationship between the Philadelphia Fed Manufacturing Index and what the non-farm payrolls look like. They track very closely together. And what they're saying right now is we could be on the verge of seeing a hugely negative print because of that. Is there any thought in your mind right now, any preparation that you're making for what could be a bad jobs report here?
Well, you're always braced for a bad jobs report, and I don't know about that statistical correlation. There's an interesting, although month to month you don't see a statistical correlation between ADP and the non-farm payroll jobs from the Labor Department, over time, there's a pretty good correlation. It's not a bad report. So if I were to say anything, I would say your best bet on Friday is, again, something like 80,000 total non-farm payroll employment, 95,000 in jobs. Brace yourself for a bad number, and recognize that part of what's going to be in the numbers on Friday is about a $45,000 from the strikers at Verizon, and that may distort the numbers quite a bit.
I'm going to take the other side to what Dom was just saying. You know, I think back to May, when you had an ADP expectation of 175,000 jobs, and we got 38,000. Right. Hugh said these numbers were pretty close to being in line with expectations. I'd like to show our viewers a chart that Citigroup puts together. Actually, we don't have it, but basically what it tells you is that expectations versus what we're actually getting have been coming up over the last 3 months. In March, they were as high as they've been in years. Then they came way down. But over the last 3 months, it's almost as if expectations are back in line. And so the question isn't really whether we're in a recession. It's whether or not the market has priced in a recession. Because if it has, then there's an argument that you can actually see a stock market that moves up on pretty weak numbers, if those numbers are better than expected.
Right, because if they've already priced in,
right,
as you say, that dismal news. I mean, well, Hugh, has the market priced that in yet?
If you take a look at the performance of the market, not just the last 5 or 6 days, but the performance of the market over the last month, it's fairly clear that the message of the market was that we're headed towards a double dip or a recession. That was not confirmed by the economic numbers. There's that big divergence. The economic numbers have not been that bad. So I would say the answer to the question is yes, the market has priced in at least some recession or some double dip. And what it's appearing to look like right now is that we're not headed towards a double dip. We're not headed towards a recession. We have slow growth with some help on the way, possibly, from the Federal Reserve, based on the minutes of the Open Market Committee meeting that we saw yesterday. And I'm starting to get a feeling we might get something out of Washington in the way of a jobs program. So you'd be surprised. Yes, I think it's all priced in.
But Hugh, if it's priced in, though, are stocks cheap? Is this a buying opportunity?
Oh, yes.
If there's Fed stimulus coming, if it's already been priced in, why aren't we all buying stocks right now?
Given certain assumptions, and that's the real question, given the assumption that the consensus forecast for the economy, 1.8% this year, say 2.4% next year, is correct, then the stock market is undervalued, about 12% undervalued. But that's the assumption, and that's the question you have to ask. Is it going to be 1.8% or lower? Is it going to be 2.4% or lower? My answer to that question is I believe that this is just a correction. It's just a soft patch. Those numbers are pretty good. And if they are pretty good, then the stock market is undervalued. And again, it's about 11%.
All right, Hugh, thank you. Hugh Johnson, Bloomberg Best Chairman and CIO, of Hugh Johnson Advisors.